Gene, thank you for joining us today. Certainly you've had a fascinating career as the CEO of Wellington. You started as administrative assistant. You've risen over 30 plus years to CEO. Give us a sense of the path and sort of the journey that took you to where you are today.
So thanks for having me today. So I've been at Wellington, this is my 34th year, and I'm not unusual. There are many, many people at Wellington who have decades-long career. I'm probably unusual in how I started. So as you said, I started right from Wellesley College as an administrative assistant, and I like to think about my career in decades. I was always in the research department, so I spent the first decade becoming a biotech and pharmaceutical researcher. The second decade was about managing money. So I started running a biotech fund, a biotech long-short fund, and then I started shifting a little bit towards leadership at the firm. Wellington, I went to London in the middle of the 2000s as we began to expand our investor base in London and moved my whole family there. And that probably started my leadership journey. Wellington's a private partnership, and so in 2014 I became a managing partner in addition to all of my money management responsibilities. By then I was managing everything from Vanguard Healthcare to long-short biotech. And then I never thought I would become CEO or had any ambition to become CEO. It sort of came on very slowly. And then just about 5 years ago, we announced that I would be the next CEO of Wellington. And it was really about how did I want to spend my last decade at a firm that provided so much for me. And so I've been in the role for, this is in my 4th year as CEO, and having fun.
So when your partners came to you and said, hey, Gene, we think we want you to be CEO, how did you think about that in the context of what you had been doing on the investment side? Was it a surprise? Was it a challenge you were ready for?
Well, that's not exactly how it works.
Okay.
So it's a long succession. One of the things that Wellington does well is when we have portfolio management successions, and obviously when we have leadership successions, it's a multi-year process. And so it was really about some of the senior people at the firm saying, do you have and it was more about, did I have the skill set? And I was working so closely for many, many years as a managing partner with our CEO. And I think there are a lot, particularly from my perspective of I was in 10,000 company meetings. I observed management teams across all of healthcare for so long. They were parts of my job and parts of my experience that I think very much resonated with managing a company. And so, yeah.
So you were CEO and you still ran the portfolio for some time. When did you actually stop managing money day to day?
So when I became CEO, I gave up sort of the fun hedge funds, the hedge fund stuff, and the small cap investing. But I did keep Vanguard Healthcare Fund, which is a large $50 billion fund that I managed until 3 weeks ago. So it's just very, very new that I've stepped down from managing money.
So you mentioned that the Vanguard Healthcare Fund, a lot of people know the name Wellington. They may not fully appreciate some of the clients and partnerships you have. Maybe talk a little bit about the business of Wellington.
Yeah, so Wellington will be 100 years in 2028. And so for those of you who don't know us, because we are a private partnership, we tend to be a quiet company. Right. Our roots started in 1928. We were once one company with Vanguard. So there was a split in the 1970s. We were once a company that ran both the money and the distribution. In 1975, Vanguard went their way with the distribution, and we became the money manager part of the fund. So you can imagine, I think it's quite interesting. It's quite an interesting case study, how both companies started in crisis. The modern day Wellington and the modern day Vanguard. And we had a star portfolio manager, so they needed us. We obviously needed them. And now they're our largest client and a terrific partner with us.
So it sounds like it was a friendly split.
Not at the time. Not at the time, but it became, the relationship was mended and now we have an incredibly strong relationship.
Okay. One of the the key attributes of Wellington, and you saw it in how you ran the fund, is really the role of like active management in markets today. Over the past few years, we've seen the rise of passives and ETFs. Talk about the role of active management in portfolio allocation today.
Yeah. So Wellington is a proud active manager. So that's all we do. We maybe just take a step back before I go into exactly how I view the role. But we manage public long equities, long fixed income, long short, macro, credit, equity, and now for the last 10 years, private equity and private credit over the last couple of years. So when I think about that whole spectrum, I think of that as active management. So any part where you're not following an index. I think active management is incredibly important, has been an incredibly important part of the past, and I think will be an extremely important part of the future. Of course, it's very difficult to replicate the alternatives part of the active management world. When you think about private credit and private equity and anything to do with long-short hedge funds, what's happened in the past decade is that you've seen the real rise of passive forms, first in equity and also in the last number of years in fixed income. The one thing that I know, and I hope the allocators in the room believe this too, is that if you can outperform an index, and you can justify your fees, your active fees, I believe there is a really, really strong place for active management. The compounding effect of that is so powerful over time. And so I think we're at the stage where active management, even on the public side, could become even more important over the next decade. And the reason for that is that the markets are so concentrated. You know, you saw what happened yesterday in the market. The markets are so concentrated that actually an S&P 500 index is potentially one of the most risky things to buy right now, like the concentration of that. And so I do think that there's been a headwind in the last, just as passive has risen, and I was listening to Howard Marks earlier, the active markets did not benefit from the sort of the interest rates, the easy money, that like really lowered dispersion. And just as that was ending, then you had this immense concentration. And we've sort of never seen a concentration in one subsector of the economy as we've seen in the last couple of years. So I think when you enter a more normal financial market where QE is not present, and as the breadth of the market widens, there's going to be a real place for active management.
Many people may not be aware that as part of your active management strategies, for many years you've had a successful and growing hedge fund platform. So talk about the strategic decision to kind of launch that hedge fund platform and how it's evolved.
So I said I was a hedge fund manager for 20 years at Wellington. So it started, our hedge fund platform is 31 years old, right around this time. It started with talent. So we had someone who was going to potentially leave to go and run a hedge fund. We had a desire at that time for some of our best investors to want to manage long short as well. And so as we do respond to talent and great ideas, we started a hedge fund business. That investor actually is still with us today. An amazing investor. And so if you think about the 90s, we started with a number of long short equity. So our equity investors really followed the path of both running long assets and running long short assets. In the 2000s, we built up our macro hedge funds. And in the last 5 years, one of the things we did in 2019 is the hedge fund industry was changing so much. What did we want to be, and where could we really be competitive? And I will say, like hedge fund investing has a very strong place at Wellington. Some people ask me, does it fit with your culture? Because Wellington has a really strong culture. I'm like, absolutely, positively, it fits with our culture. As I said, I had long short money for many years. In the past 5 years, what we've done is really focused on our hedge fund business saying what will it take to be very competitive and top tier competitive. And so that has resulted in a number of investments we've made in technology, in systems, in attracting talent, and how we're developing our investors, the vehicles we need to be competitive, and so I'm very excited about, and you can see the fruits of that. And what I mean by that is you can see the fruits in returns,
Right.
which is my most important milestone and my most important North Star. And so I think that there's a very strong place in our firm for long-short investing.
So the last couple of years, we've seen this war for talent with a lot of the multi-strat hedge funds, competing, paying lots of money. How does Wellington sort of compete and attract talent in a market that is so fiercely competitive right now?
So obviously, if we couldn't compete from a compensation perspective, we wouldn't have a business. But one of the beauties of Wellington is that we are a private partnership. And I'm one of the 3 managing partners. We're just about to go into our comp season. And one of the things about our compensation is that we can run a hedge fund business, we can run a privates business, we can run a long business, and it all makes sense within our private partnership structure. Our compensation is very competitive with other firms. Otherwise, why would anyone want to come?
And it seems like you have the platform to plug teams into.
Exactly.
And we've seen over the last couple of years, a lot of the pressures on managers, and many are deciding to join platforms rather than start their own these days.
And I think our value proposition for talent is that people want to come to a firm and have their last 10, 20, 15 years at a firm where, one, they can benefit from if I had to say one thing, if there's one thing that I think is unique about Wellington, because every firm has a uniqueness and what their strength is. And our strength is our ecosystem, our investment ecosystem. It's insanely collaborative, and I really everyone talks about being collaborative. It's an open, collaborative system. And so our head of our hedge fund business will say, you can come to Wellington and be better at your craft because you're part of the ecosystem. Right. So people who we attract want to collaborate, and they want to learn from others, and then they go and take that collaboration and then do what they do so well. So those are the kind of people that are very attracted to our platform.
So I want to come back to something you said earlier about the public and private market convergence at Wellington, which is definitely a broader market theme we've seen. Talk a little bit about Wellington's strategy for having both types of strategies on the platform, the benefit of having both.
Yeah. So we started our privates business a little over 10 years ago. It started with one investor, just like our hedge fund business started with one investor. Our privates business started with one investor, some very innovative investor, and he was a growth manager, and he just recognized that companies were staying private for longer. Now, that's such an obvious statement. Everyone's like, yeah, isn't that obvious? It really wasn't in 2012 and 13. It was just starting that, wow, there's fewer companies going public. Yeah. So interestingly, at the time, I think our management team thought, well, we are a public active investor, and he really pushed our firm. He reports to me now, and he still does this. He sort of went around everyone, got a bunch of us to commit money to the first privates fund, and that fund actually launched with 2 big anchor clients. So that was the beginning, and from that we did biotech and other things that made a lot of sense from an adjacency perspective. In 2025, when I think about our privates business and we have a roadmap for the next decade, I think about where, if you take our long equity and our long fixed income business, we are really strong in sectors. We are really strong in sort of research-based fundamentals. We have a very strong credit footprint and fixed income structured footprint. And so along those adjacencies, there's real adjacencies for us to have and attract investors on the private side and generate really compelling returns. That's the goal. I kind of say anything where you can analyze a credit or an equity makes sense for us on the private side. I think there are some businesses on the private side that it wouldn't necessarily make sense. It's not our skill set. Maybe 15 years from now, but not in the next decade.
So in terms of how Wellington's structured, if you're looking at a biotech investment, a public or private company, do you have one team that's the sector expert and then they allocate it to different funds? How does it work?
We started with our public investors putting some privates into funds. We made the decision first around 2014 that we were going to have separated funds, so they weren't going to be, one was public, one was private. We weren't going to have in the same vehicle. And then 4 or 5 years ago, we also said we want dedicated. So if you either choose to be on the public side or you choose to be on the private side. So we do have people that are for instance, on our healthcare team that do private investing and then do public investing. But the beauty is the collaboration between the two. The collaboration between those public and private investors. And I've sat down with a number of our private investors, and one of the things they will say, and I just got emails this week about how our investors all over the globe have helped one of our private teams, with a recent deal. Sort of that ecosystem, that deep knowledge of sectors is really helps our private investors as well. And then our private investors, they just share what's going on in this broader ecosystem. And back to like 10, 15 years ago, 20 years ago, most of the economy was in the public markets in terms of numbers. And now increasingly, a lot of the economy is in the private markets. And so we need to know what's going on. Like in order to actually analyze what's going on the public space, you actually need to know what's going on in the private companies to sort of have a holistic view of the economy, which is that's our job.
Yep.
So.
You mentioned 2012 was when the privates on the equity side started. Talk a bit about the private credit strategy and how that's evolved.
So we started first with private equity, and we started a number of years ago then on our private credit strategy, and we're building it. We'll have our third team here very shortly at Wellington. So we started with investment grade, and it was just a perfect adjacency to our public investment grade capabilities. Debt lending was our second, and so we have plans for a number of different capabilities over the next number of years.
So you've got a tremendous product set at Wellington, a great institutional client base going back a long time, but the market's shifting in terms of who wants access to alternatives. So this theme of retailization, democratization of alternatives, who has access? How are you thinking about the retail high net worth channel?
Yeah, so if you take our privates business now, the interesting thing is that half of that business is from our private banking clients. So over the past decade, we've been in the wealth market, but as you say, at the high end of the high net worth, ultra high net worth sector. As I go around and as our colleagues go around the world and talk to the wealth market, and I mean the wealth market anywhere from those ultra high net worth private banks, all the way to mass market firms that are in the middle of the U.S. It's what's universal is every one of those management teams are looking for ways to bring alternatives to their clients, and you probably have heard the statistic that in the wealth market, 2 or 3%, about 3% is in alternatives, and that's really very, very concentrated in a very small amount. And so when you think about, so what we're doing is trying to partner with those clients and find ways, and that just means the investments are there. It's more about how you bring it. And so vehicles are going to be really important in terms of interval funds and evergreen funds. We hear from our clients, they want easy tax forms, that like when, as these types of vehicles become more prevalent and they get tested, like liquidity is going to be, the liquidity management, it's a new skill, will be very important, but those will be the vehicles that will be able to be qualified to a whole group of a whole different group of people that have not had access. And when you think about fairness, and like just a very small part of the world has access to investing. If you go back in 20 years and as you think about the index funds and mutual funds, like the world had access to most of what was happening in the economy. And now there is a huge part of the economy that most people don't have access to. So I think from a fairness perspective, I think from a market perspective, holistically it makes sense. From a fairness perspective, it makes sense. And
yeah, certainly one of the things at MFA that we're focused on is as this conversation plays out and more retail has access to alternatives, the regulators and public scrutiny comes with it.
Yeah.
As more individuals potentially, take on greater risk, there's going to be more regulatory scrutiny, and finding that line will be important for us. Yeah. I wanted to ask you about one of your recent product launches. You recently launched an interval fund basically with a hedge fund product in it, which seemed pretty innovative. A lot of the interval tender offer funds you had seen were more focused on sort of longer term hold type strategies as opposed to the one you launched. Talk about how that came to market and the strategy behind it.
So the strategy behind it is a multi-strat hedge fund, which has a combination of diversifying macro, emerging market, credit funds, as well as our long-short equity funds. So we've actually had multi-strat. This goes back to Wellington getting better at vehicles. We've had a multi-strat hedge fund, for a decade, and it was designed in a way back then that made sense at the time, but wasn't really set up to do leverage in the way that was necessary.
Right.
And so we spent a number of years successfully then launching it in the right sort of format. And then since we have had that format, then we could launch it in vehicles. So we have fund companies all over the world, right? The only place that we didn't have a fund company was in the US. Because we have these great partners, and if we go back to the beginning of the conversation, since we had that split, we haven't had a 40 Act mutual fund. So this is our first 40 Act mutual fund since 1975, and we're launching what can be in an LP form. It can be in a form that goes to Europe and Asia, and now in an interval fund.
And how have the early days been? Are you happy with the launch?
It's just launched.
Okay.
Just launched.
So it'll come. All right.
I'm very enthusiastic. It's the first of its kind.
No, it is.
So.
It was very innovative, and congrats to you and the team, and Mark Sullivan, your colleague on the MFA board, has been very involved. I want to change topics now to talk a bit about technology and AI and how Wellington thinks of it both from a investing perspective as well as an operational. As we're starting to see, AI is not just an investment theme, but it's affecting how companies operate day to day, how they hire, how they staff. Talk a little bit from your seat, former investor, as well as with the CEO hat on.
Yeah, so I won't give a prediction of like the stocks because I'll leave that up to our technology investors. But maybe I'll address it from two perspectives. One is like, what is Wellington doing? A few years ago, I was at some meetings with CEOs, and we had actually one of the founders of OpenAI present, and you could hear a pin drop in the room. Now this is a couple of years ago, and it was before the announcement of OpenAI and then after the announcement. There was two meetings, and so I guess I was fortunate enough to be in those rooms to say, all right, what are we doing? Like, let's make sure that we have that we are on our front foot about how we're going to use AI. So we have use cases now within Wellington on the investment platform, both on a productivity and an insight. Like we meet I'll give you an example. We meet 20,000 companies a year. That's our proprietary data, and 85% of us take notes on OneNote. So we're creating a data lake that anyone can use. Like, it can connect dots faster than even our super collaborative ecosystem can. So we're trying to find ways to make investors more productive, to take all our proprietary data and have more insights. And then we are seeing from a technologist perspective productivity. You probably have heard that technologists are 30% more effective, and that kind of started off slow, but we are seeing the productivity in coding. So that's and everyone has access to Copilot now. So we're trying to democratize it at Wellington so everyone can use it in their day-to-day work and try to become more productive. If you look at sort of market structure, and I did talk about this earlier, I mean, it's really, really quite unusual to have the concentration in the markets. Now, if you go back in the 70s, like my mentor grew up in right after the Nifty 50, so I heard a lot about the Nifty 50 period. But that was broad. That was a broad aspect of the economy, growth stock. This is one. So one of the things I've been saying, it's been such a headwind, particularly if you look at U.S. portfolios, and particularly with like mutual fund rules, you can't even be overweight those 7 stocks. So one of the things that's clear is it's either AI gets distributed broadly in the economy to your company and my company and everyone's company out there, and there are real cases that help us improve our earnings, either through better products or better productivity. I think we're still a few years away from that. Right. That will be the AI applications, or the earnings of those 7 companies are too high. It's such an interesting thing. There's only 2 outcomes. And I don't know when that will happen, but I think yesterday's action was just it's sort of a market structure comment than sort of, is DeepSeek, is that going to change the competitiveness? Like, I'll leave that to my investors, but it's just a market structure. It's so unusual. And I think anything that broadens out the market is healthy.
So as we wrap here, let's finish on sort of a macro question. You mentioned DeepSeek, market events of yesterday. Tomorrow, the Fed makes a rate decision. We've got new administration talking about tariffs and lots of political and regulatory uncertainty. How do you think about that as a CEO, and then how does that translate into how you run the firm?
So I think from a CEO perspective, we are, one of the things I like to tell our employees, like, we're in such a fantastic business. When you look at models of firms, if you think about the compounding of so we're really highly levered to the compounding of the economic growth, productivity, prosperity over long periods of time, and so I don't ever apologize for beta, right? That's our business. And so, but everything that happens, innovation, macro, that's part of the job, right? And there are periods of time when so if that's our business, what disrupts that business? And over time, geopolitics and innovation and inflation, interest rates, they all have an impact, and that's what we do. That's why clients pay us. They pay us to figure out how to adapt and adjust to all of those forces. So if it was a boring world, we would not be paid.
That is why clients need alternative asset managers in their portfolio. Yeah. So we will end it there.
All right,
Hynes, thank you very much. Very much appreciated.
Thank you very much.